Big news yesterday, Dad, from the Federal Reserve. Interest rates, the federal funds rate, going up another 75 basis points. At the same time, auto loan rates haven't been this high since the Great Recession. Pops, what the heck is going on in auto right now when it comes to financing? And I think we also have some earnings from some of those subprime lenders that don't look so hot. Give us the rundown of what's going on.
Well, what's going on is the Fed keeps raising the Fed rate, and auto loan and consumer loan rates continue to go up. I believe the rates are the highest, or they project the rates will be the highest they've been since 2001, which would indicate to me, especially since the Great Recession, that, well, we as Americans have gotten used to what you could call cheap money. And we have used that cheap money to stimulate the economy for years and years and years. And, well, now through all that stimulation, it's created globally inflation. And one of the tricks that the Fed seems to use to fight inflation is to raise rates. And it seems to be working.
Now, Pops, let's quantify, or at least put into context here, how available credit was in auto for the past, I don't know, let's do 18, 24 months. Credit Acceptance Corporation writes auto loans for deep subprime borrowers. Think loans that are 15, honestly scary to think, but up to 30% interest rates, APR. That here is the data from Credit Acceptance Corporation from 2013 to 2022, how much they were lending and for what term. And it puts into context just how available credit was, even to those who, I hate to say it, had either thin files or weren't particularly credit worthy. In 2013, Dad, the average consumer loan that Credit Acceptance Corporation was writing was $15,445, and it was a 47-month term, okay?
Yes, okay.
I'm going to jump ahead to 2018. $22,158 was the average loan amount and a 57-month term. Whoa.
Wow.
And then, Dad, in 2022, the 3 quarters so far of 2022, the average loan amount from Credit Acceptance Corporation, a whopping $27,197 on a 59-month term. And again, let this sink in. That's probably on average a 22 or 24% interest rate. Pops, the availability of credit had been easier and just plentiful for the consumer. Now, not so much.
Well, now it's just becoming more expensive, and it's taking people out of the market. Loan applications have gone down, and the unfortunate reality for Credit Acceptance Corporation, now that you've extended the term for most of these people on average to 59 months, it gives them 59 months in order not to make the payments. So I would think there could be any number of repossessions coming up because things are just out of hand payment-wise, term-wise, interest rate-wise for the subprime and deep subprime sector.
Yeah, and take away just subprime and deep subprime, Dad, the average new car interest rate is up over 6%. The average used car interest rate across the board is north of 10%. Our expectation is that those are obviously going to go up. And Cox Automotive did a piece talking about rising interest rates, rising federal funds rates, and how that's going to hamper the economic activity within the automotive sector. And they're 100% right. This also impacts, Dad, the floor plan costs of the dealers that are holding the inventory. They finance those purchases, so they're paying more to hold the inventory too.
If you were financing several $1 million of inventory at 1%, the cost is minimal compared to financing that same amount of money when floor plan interest rates might now be hovering around, 4 or 4.5%. That's a sizable chunk of change that dealerships have to write to their floor plan lenders every month. It's a cost that had been minimal for the longest period of time, and now it's reminding dealers of what floor plan interest charges used to be prior to the Great Recession.
Thinking about getting auto insurance? Compare quotes from all the major carriers in one place. Join YAA.com/insurance. It's quick, easy, and no spam. Now, one other component of this that I think is worth talking about, Dad, we've seen the divide in those who can afford and those who cannot afford to buy vehicles. Rising interest rates takes even more people out of the market, especially with used car prices as inflated as they've been. Sure, they're coming down. Watch our videos each week. Used car prices are coming down. Don't get us wrong, but they're still unattainable for many people. So I think we are continuing to see, as interest rates rise, the bifurcation, the division of those who have and those who don't. And the wealthy, they're going to own cars, and those that don't have affluence, they're going to find ways to get from point A to point B, but it might not be buying a vehicle.
Yes, and we've touched on this for, I don't know, the past 8 or 10 months, that we saw this chasm widening between those who could afford to buy cars and those who can't. And as that chasm gets wider and wider and wider, the amount of people that are actually in the market is shrinking. Yes, wealthy people can still afford to buy cars, and wealthy people are still buying cars. But the car market wasn't made up of just wealthy people in the past. It was made up of affluent people, middle-class people, lower-income people, and today it's becoming just, affluent and wealthy people. So the pie is actually getting smaller because you have less people in the market, because you have less people that can actually afford the monthly expense of owning a vehicle today. And owning a vehicle includes financing that vehicle. And that part of the equation is making it harder and harder for more people.
Well said, Dad. And hopefully, this is knock on wood, that will force some automakers who are striving to gain market share to lower the price of the vehicle to get those lesser income buyers. I hate to even say lesser income, just like middle class buyers back into the market. So maybe this will help force some downward pressure on price. No guarantee there, but I mean, theoretically it could.
You know, in theory, the theory behind manufacturing automobiles was always to include just about every class of people, everybody that could possibly afford to buy a car, and to keep that market expanding. Well, now that market's contracting. That's not what the manufacturers want to see happen. They want to have more people be in the market to be able to buy a car rather than fewer people. So this doesn't bode well for future growth in the automotive sector as much as many people might think. EVs. Everybody's talking about EVs. Well, they're even more expensive than gas-powered cars, which means that there's even less likelihood that people of lower means will be able to get into one. So if the amount of people who can actually get a car continues to contract, the idea of selling 17 million new vehicles in America every year is just a pipe dream. Because there's just not a big enough market.